Have you ever wondered how trading actually works? So what is trading anyway? Imagine you really like a pair of red underwear. Nobody else wants it, but you do. So you buy it, then suddenly Superman starts wearing underwear. That starts a trend. Now everybody wants a pair, but there's only a limited supply. The price keeps going higher and higher. So you sell it and make a profit. But here's the real question. How can the price suddenly shoot up or suddenly crash in just a split second? Is it because a new Superman starts wearing a different pair of underwear every second? Well, not exactly. Well, sometimes, yeah. A trend can definitely move the price, but only for a while. The price is always fluctuating.
Are you serious right now, bro?
So what's actually making it move all the time? Of course, it's not a new Superman every second. The real reason is millions of traders, investors, and even giant companies are buying and selling every single second. Some people believe the price will go higher, so they buy. Others believe it's about to fall, so they sell. Every trade has two sides. If you're buying, someone else is selling. Maybe they've already made a profit, or maybe they think the price is about to drop, and that's what keeps the price moving every single second. Now, you might be wondering, where does all of this happen? Nobody's standing in the middle of the street yelling, "I'll buy, I'll sell." Today, almost everything happens online. Trading platforms connect millions of buyers and sellers from all over the world in real time. Now let's talk about the different kinds of markets. Now you might be wondering, what do you mean by markets? Isn't there just one market? When it comes to digital trading, there are four major markets: the stock market, the Forex market, the crypto market, and the commodities market. Now let's jump into these four markets. Let's start with the stock market. Every country has its own stock market. For example, the Netherlands has Euronext, Amsterdam, Switzerland has the SIX Swiss exchange. And in the United States, you've got the New York Stock Exchange, better known as the 91. This is where companies offer a small portion of their ownership to the public. Those portions are called shares. People can buy those shares and become small owners of the company. If the company grows and becomes more valuable, your shares can become more valuable too. And if you sell your shares for more than you paid, you make a profit. Now let's move on to our next market, the crypto market. Crypto isn't controlled by any single government. And here's the crazy part. The creator of Bitcoin has never been officially identified. The only name we know is Satoshi Nakamoto, but nobody knows who that really is. Crypto is made up of digital coins. People buy and sell those coins with each other. Just like every other market, the price depends on supply and demand. Some of the most popular cryptocurrencies are Bitcoin, Ethereum, and Solana. So let's move on to our next market, the Forex market. Forex stands for foreign exchange. This is where people trade one country's currency for another. For example, US dollars for euros or Japanese yen for British pounds. The value of every currency is always changing. If you buy a currency at one price and later its value goes up, you can sell it and make a profit. That's why the Forex market is the largest financial market in the world. And yes, everything happens digitally with just a few clicks. So let's move on to our final market, the commodities market. This market is where people trade commodities like gold, silver, and crude oil. Now you might be wondering, do I have to keep a barrel of oil or a pile of gold at home? This is my cat Pussy. She's an orange tabby about 20 centimeters tall. She's super friendly. She loves following me around and getting into trouble. She's always curious. When you're trading online, you don't actually store the physical commodity. You're simply trading its price digitally. If the price goes up after you buy, you can sell it and make a profit. And if the price goes down, you could lose money too. So that's how trading works. Now you know why prices move and the four major markets you can trade in. But here's the next big question. How do you actually think of a broker as the middleman between you and the market? Imagine you want to buy something, you place your order through a broker. The broker's job is to find a seller and complete the trade for you. Once the trade is completed, your shares, cryptocurrency, or other assets appear in your trading account. Now imagine the price goes up and you decide to sell. You press the sell button. The broker finds a buyer, completes the trade, and the money is added to your account. Sounds simple, right? But here's the important part. Not every broker is trustworthy. A regulated broker follows strict financial rules to help protect your funds and execute your trades
Are you
fairly,
serious
but
right now, bro?
scam brokers do exist. Some make it difficult to withdraw your money, others disappear completely with their customers' funds. That's why choosing a trusted regulated broker is one of the most important decisions you'll make before you start trading.
No!